Hello and welcome to this special webinar from Fat Profits. My name is Roger Malik. I'm the host for today and also the head of client services in our Sydney office. Joining us today is our senior account manager, Chris Balafas. Chris, welcome to the webinar. How are you today?
Hi, Roger. Thanks for the warm welcome. Yeah, nice to see so many logged in today. We look forward to going through a bit of material that we prepared.
Absolutely, always good to share some market updates. There's a lot taking place in the market, so we'll get into it in a moment. But before we get into our presentation today, usual disclaimer: all our presentations from Fat Profits are general in nature. We don't provide any personal advice during these presentations. If you're looking for that, please see your financial advisor or planner. And also, past performance is no indicator of future performance. And during today's webinar, because we have quite a few attendees, as we can see on the screen, we will take some questions. If you have any questions on the markets or particular stocks that we're talking about, please feel free. You can type those questions on your screen, just where you see the orange arrow, and we will answer them towards the end of the webinar. So let's get into it. So first thing first, we'll talk about the macroeconomic backdrop and give you a bit of a market update from our perspective, because there is a lot of talk at the moment between the bulls and the bears. And I think one of the obvious questions on everyone's minds is, are we going to see a recession starting with US and potentially going into other economies, which will not only impact us potentially on a personal level, but could have ramifications right throughout the financial markets, our superannuation funds, our own investments, property, and the whole works. So there is concern, yes, but let's dive into some data and let's have a look at what's the likelihood of that happening. So first thing first, let's talk about Europe, which not a lot of analysts are talking about. But Europe, there is a pretty significant possibility of a recession in a few countries. And now the data is starting to come through in terms of inflation. The ECB is starting to raise interest rates as well. And largely thanks to the invasion of Ukraine from Russia, because that's really pushed the prices of gas. As you can see on the charts here, the imports of natural gas have skyrocketed, which is pretty concerning. And some economies, including Germany, which has historically been one of the strongest countries in the Euro region, are now facing unbelievable inflation. If you look at this next chart here, German inflation, producer prices have gone up to 37%. It's unheard of, and that's having a huge impact on manufacturing, huge impact on consumer spending, and the central banks over there are trying their best to control this inflation. But as long as Russia keeps this war going, there is no end to sight on this gas problem there in Europe. So that's one concern. Second thing is the trade between Europe and China. And you can see here on the charts there, the red line shows the imports from China into Europe, and the blue line shows the exports. Now, while the imports into Europe have been pretty strong, but the balance is now starting to tip on the downside. And that's partly thanks to China also coming into a potential recessionary environment. And let's talk about China next. And if you look at the Chinese data, which there's always a question mark on the accuracy of Chinese data, but let's just call it as we see it. The economy is slowing down. The last quarter, as we can see on here, the Chinese GDP shrunk by 2.6%. And the last time that happened was obviously the COVID 2020 March quarter. But Chris, the Chinese economy, now the property sector is really slowing down. In fact, they have a lot of concern in property. Their unemployment is rising. They have issues with COVID as well, and the general economy is slowing down. What are your thoughts on how we see China at the moment?
Yeah, interesting one, Roger, because it's good to know what's happening in Europe. But I mean, we don't need to tell you that we really need to understand what's happening in China. Very interesting for us over here in Australia. You know, second biggest economy in the world. So Australia, as we all know, we really rely heavily on what's coming out of China, whether we can believe the statistics or not. What's their growth potential? They've been quite good through that pandemic phase, but obviously, as Roger mentioned, you know, we're negative at the moment in China, and there's a lot of fears, as Roger mentioned, with unemployment. The fact that COVID is still around in China, it is putting a lot of pressure on the economy. And actually, Roger, we've been getting quite a few calls over the last few months from members, just actually asking, even my members, well, where do we see China? Is it going to impact Australia in the next 12 months? So it's definitely worth knowing about, even though we're not maybe investing directly in China, Roger. It's good to know, is it going to impact our portfolios and our super funds?
Yeah, very good point. Look, Chris, China, is one of those. I mean, Europe, we don't have as much of a trade with when it comes to Australia, but China in particular, we export our mining, our commodities. China is the biggest buyer for us. And if China really starts to slow down, that's not only going to have an impact on our mining companies, but which is an important part of our GDP. And of course, important part of our portfolio, the likes of BHP, Rio, and the others. However, our property sector also has an important component which could come into play. So there is a concern here. So if anybody's sitting there thinking everything is rosy and we're going to have a bull market, well, you need to think twice, because there is some storm clouds brewing at the moment. Here's a quick look at the currencies. And one of the headwinds that we're facing is the US dollar. And the US dollar has been very strong in the last 12 months, and partly thanks to it being used as a safe haven in volatile times. And you can see here the strength of US dollar versus the other currencies. For example, the green line you see is the Australian dollar. So the AUD is held up better compared to the other currencies. Then you've got the euro, the pound, and the Japanese yen, which has really struggled due to how they're facing challenges with their economy. Now, if you look at the US, so that's probably the other final country for us to keep a check on before we talk about Australia, is the US in the first 2 quarters of this year have actually contracted. The GDP has gone negative, which technically is the definition of recession, is 2 negative quarters in a row. If you look at the charts, it's pretty obvious they are in a mild recession, but it is mild at this stage. So the government, the policymakers, they are playing it down, and they're saying, look, we're not in a technical recession yet. Look at the unemployment, look at this and look at that. So that's fine. There is hopefully a soft landing around the corner. However, something to look at is over the next 12 months, if the central bankers don't get it right, if they can't get the inflation under control, and if they keep raising rates at a rapid pace, then we could see all of this unravel. We could see a hard landing in the US, and that could trigger a downward spiral in the property market, in the financial markets, and it could trigger a recession across a few other countries. So that's something to be aware of, and something to keep in mind. Now, having a look at the S&P 500 next, before we look at Australia, this is the benchmark for all the world to follow. There's top 500 companies globally. If you look at this setup, for those of you like your technical indicators, you will notice that we put some Fibonacci indicators on this chart, and the orange line represents resistance. The green line represents the downwards trend, and you can see it's currently in a bear market. This is a bear market chart, and the market is showing lower lows, lower highs. It's tried to bounce off that green line twice now, and it has failed. And now we're back again potentially looking at another sideways movement and potentially another leg down. So until and unless the government, the policymakers can get it right, we are likely to see this bear market continue. We're expecting September and October to be pretty weak months. In fact, we're expecting another leg down in the market. So, Chris, let's talk to you about inflation as well next. But this leg down, we've been flagging this for a couple of months now, and we'll talk more about it in a moment. But inflation is a worry, and not just for an average consumer, but it is a huge worry for the policymakers. Let's have a look at New Zealand first. So can you run us through what's happening there?
Yeah, you make some interesting points, and earlier you mentioned the geopolitical tension with Ukraine and Russia. And it's funny, Roger, that's still going on, but no one's talking about it. The big story globally, and what we hear, again, the questions from members, is inflation. What's happening? We're going to go through New Zealand, the UK, Australia. So we can see here that the consumer price index, inflation in New Zealand, hits 30-year highs, currently at 7.3%. So, the talk of the town is globally inflation. And many members are asking this. New Zealand at the moment are really struggling to control their inflation. As we can see in the next slide here, their cash rates at the moment are around 3%. And people are asking, how is that going to impact the economy as well over in the New Zealand exchange?
Yeah, absolutely. Look, the central bankers are trying the best to get this under control, but it's the old saying, Chris, once the genie's out of the bottle, it's hard to put it back in. And
yeah,
unfortunately,
and
they've been a bit behind the curveball.
Yeah, and even though they're a small economy, Roger, we still need to understand, what's going on there. I mean, the UK is the big one. I was in the London office during that period there of 2010 to 2012, and that was when inflation was at 6%, and we could actually feel the effects of the inflation when it was around 6 and 7%. Now we're talking about 10% inflation. So yeah, the Bank of England and the Fed over there, they're really trying to take hold of the inflation, and we're going to see as well with their interest rates. So yeah, a lot happening in the UK too.
Yeah, absolutely. So New Zealand actually is a bit of a benchmark for everyone else to look at, because they were 6 months ahead of everyone else when they first started. They were the first Western country to actually raise rates. And they're 6 months ahead of everyone else, but still the inflation is not under control. So that's a concern. The UK is in double digits already. Let's see how that shapes up. Australia so far is only at 6.1%, but our figures only come out quarterly. So we'll see how the next quarter shapes up. But the RBA has already said we're looking at 7.7% or thereabouts for it to be peaking. Let's see how the next quarter shapes up. Currently, the RBA cash rate is only just under 2%. So there is plenty of room for the RBA to take this up to 2.5%, 3%. That's the expectation. If you look at US, for example, they're currently at 2.5%. Again, the powder is still dry. They can go up to 3%. Expectation in US is actually for them to go to 3.5%, even up to 4%. Some are calling 5%, saying the Fed's not doing enough, but well, obviously time will tell. So all this, how does this shape our financial markets? I think that's the first question for us. So what we do at Fat Profits, our CEO, Angus Geddes, he writes a daily email in the morning to our members, and he provides market direction, because Angus is also a fund manager, and he's managing over $250 million in the market. So one of the things he's been recently saying, and we sharing a couple of quotes from his daily emails, is that he's expecting the US markets to drop, and he's actually removed, if you look at this bottom one, I'll read the last line here. He says, we believe the US market could consequently have further room to move lower over this third quarter, and subsequently removed nearly all US exposure. So currently our CEO is not bullish on the US market. We are expecting a recession in the US next year. and we've removed all US stocks from our portfolio at this point in time. However, we are sitting on a reasonable amount of cash for us to get back in the market when we see the time right, and that we think over the next few months the market will drop, and then we'll get into it. Chris, anything you want to add before we look at the ASX 200?
Yeah, you make a good point, and even though he's our CEO and many members and even non-members will know who Angus Geddes is, look, it's a diary to a fund manager, investors. So Angus is telling our members what we're doing with our money, what we're forecasting, where we feel is the right time to put our money in. So we're not trying to tell you what to do, but it's certainly a guide to just give you another option, another opportunity. No one's got a monopoly of new ideas, Roger, so it just gives our members an idea of what we're doing, if and when it's the right time to get in and get out of the market. So the daily is a great source of material just to give us a bit of guidance.
Absolutely. Our members, I know for sure that they read that daily email every day and they enjoy the read. Because Angus does get up at 5 a.m. every day to write a pretty long email with lots of data. Lastly, before we get into some stocks today, let's have a look at the ASX 200, how that's shaping up versus the S&P 500, for example. Now, this chart clearly shows from the March 2020 lows of around 4,400 points, where we see the markets drop from 7,200 down to 4,400 in 1 month. We all remember that. It was panic 101. However, since then, yes, we've seen a good recovery. Yes, we've seen new highs. However, in the last few months, we've seen the market pull back, bounce off the support of 6,400, and now hovering around the 7,000 points. What's our view on the ASX 200 over the next few months? Look, we think as the US markets pull back, we think the volatility will continue. The ASX 200 will trade between that channel of 6,400 to 7,000 points. We don't think we're going to hit this 7,600 points, the top end, anytime soon. We think we'll trade in volatile markets, and we're likely to see a further drop in the markets in the next 2 months, especially September, October. They are known to be pretty volatile, and we're expecting a further drop. So if you are sitting on cash, you could wait and see how the markets shape up before you buy. If you're fully invested, this recent rebound, we think is actually a good opportunity to sell a couple of stocks, raise some cash, and wait with patience, because we think there will be better opportunities to buy in the short term. Now, what I'm going to do is I'm going to open up and we're going to make it interactive today. So here's a question up on your screen, just a bit of fun. Well, we can also get your opinions and to see how everyone else feels. Do you think Australia will go into a recession in the next 12 months? And let's get some feedback from you, because everyone has, of course, different opinions, and we all know, you know, how sentiment plays a huge part in the financial markets. So we'll do that now. In fact, getting quite a few responses come through. So I'm going to close.
Quite a few yeses at the moment, Roger. There's quite a few saying not sure, and that's I guess to be understandable. The markets are very volatile. A lot of people don't know what to do. So yeah, interesting answers.
Yes. All right. So I'm going to close that now. We'll get the results. Actually, we've got the results here now. So from today's poll, we've got 64% saying yes. And that's a bit of a surprise, but then again, not really. 32% are saying no, and the others are not sure. So there you go. So maybe the sentiment is shifting, because you know the bull market is kind of behind us. So one has to be careful with your investing. So let's move on to what some people are doing at the moment, and that's a bit of a joke in the stock market, is the BHP strategy. Not the BHP company, but what this man is standing there doing, which is praying. And that's the old saying, buy, hold, and pray, the BHP strategy. Right? Now, Chris, we've all done that before. I'm pretty sure a lot of investors are doing it right now.
Yeah, absolutely. Again, it's just not knowing what to do, Roger, especially if they don't have the time or inclination or even the expertise as to know what to do. So it's actually, while it looks confusing, and you know, a lot of people are just listening to what the television and the newsreaders tell them. It's good just to get an understanding. We all hold BHB as well as this page is just showing, just a strategy. But it's nice to have a bit of reassurance, and that's what we've been doing for our members, Roger, especially since June, where we had that correction in the US. We've just been telling our members and reassuring them what they should be doing. So we're cautious, but we're still confident.
Yeah, very good. All right. Well, one strategy which we've been preaching for quite some time in volatile markets, and this will really help you if you're looking to put that cash to work, because there's no good sitting in the bank, it's going backwards, but you want to be cautious. And one cautious strategy is dollar cost averaging. And if you don't know what that is, or you know what it is, but you haven't done it, well, maybe this might prompt you. So the way to do it, we encourage our investors, if you have chosen a stock and you say, yes, I like it, I want to buy it, instead of you buying it today at a particular price and hoping that this is the lowest you're going to get, and let's just be honest, no one gets the absolute bottom of any stock or the absolute peak when you're selling, right? So the way to minimize your risk is buy that stock at different times over the coming months. So you buy it once at a certain price, you buy it again if it drops, and you buy it again if it drops. So then you give yourself 3 average entries and you bring your overall average down on a particular stock. That's called dollar cost averaging. And if you can do that successfully in a volatile market, you reduce your risk of trying to time the stock, and you certainly improve your chances of success. So that's something hopefully you can take away from today's webinar. Now, Chris, tell us about this income portfolio. Now, the one thing about this particular webinar today that we will encourage the audience to do is to look at blue chip stocks in the ASX top 200. If you want to be cautious, if you want to reduce your risk, well, this particular portfolio is designed for semi-retired, retired investors, self-funded, or even otherwise, if you're still working full-time and you want to protect your capital. Rule number one. Tell us more about this income portfolio, Chris.
Yeah, interesting, Roger. We'd all be millionaires if we just chose the top 10 highest yielders. That's not a strategy. And look, we're very proud. Our members really do appreciate the income portfolio. We've started this a decade ago. Obviously, we can't show you the stocks on the left. That's what members are paying for. But this just gives our members an idea as to what stocks are going to give them a very safe return that are undervalued, so they've still got capital growth to grow, and they're also going to give a nice strong yield, Roger. So there's quite a few stocks there for our members to choose. You don't have to choose all of them. It just, again, it's a guide. It gives you an idea of what's out there, what's undervalued. You might be ready to buy a stock, but there's actually no growth potential. So this is just going to give you an idea. And what we're very proud of is that bottom right figure. So the last decade, this has consistently been providing our members a 17.1% annualized return. And again, these aren't your high risk, high rewards that gets the heart beating. The blue chips, the ones that are giving you growth and also a high yield. And you know what, Roger, just gets our members thinking outside of the box. What else is out there other than the 4 banks and Telstra and BHB?
Yes, absolutely. Well said. So just to shed some light on this, this is a 22 stock portfolio. They're all in the top 200 in the ASX, and we update this portfolio once a quarter. So you as an investor can look at these 22 stocks that we believe have got the best potential to provide 5 to 6% dividend yield per year and give you additional growth on top of that. So the total 17.1% annualized return over the last 10 years that you see is a combination of dividends plus growth. So my question to you, and just before we go in there, is what are your annual returns over the last 5 years, over the last 10 years? How does that compare to this? So if you're doing better than 17% annually for the last 10 years, well, give yourself a pat on the back because you've done better than a whole team at Fat Profit. It's very hard to achieve that on your own if you've done that. Congratulations. If, on the other hand, if your returns are under 17% consistently, maybe you want that gap to be filled. Let's say you're doing 7 to 10% a year, which is what most investors do, and you want to bump that up to 15%, 16%, 17% a year. Work out the numbers. What would that mean for you? And these are set and forget blue chip companies. So you're not trading. We're not asking anyone to trade. These are buy and hold, and just look at them once a quarter, and we update all our investors. So that's the first thing. So now the second thing is this next table that you're seeing now, that's the same 22 stocks, and we're sharing a couple of them on the left. You can see the names on the left. This table shows the forecast of dividends to be paid out per stock out of those 22 stock portfolio. And we update that quarterly, so you know exactly what to expect and your forecasted income, which you can live off, and you can plan your life around. So as an example, if you look at the gross yield, and you can see the net yield financial year 22, financial year 23 per stock, the gross yield, including franking credits. And then on the right-hand side, you see the franking credits, which ones are fully franked or unfranked. So some stocks, for example, BHP, it is in this portfolio. You're right, Chris. We do hold BHP. It is forecasted at 12% dividend yield for financial year 23. That's obviously a clear standout, and they are on track for that. There's another stock with 10% forecasted, fully franked. There's quite a few which are 7, 8, 9% as well. So as a portfolio, it's averaging 6.6% forecasted yield over the next 12 months. So the question back onto you, would that be good for you if you could generate that consistently? Is that better than what you're currently getting? Would you be open to trying something and making a couple of changes to your portfolio? Because one thing for sure, if you keep doing the same thing, you're going to get the same results. Chris, pass it on to you. Anything to add?
Yeah, can I just say as well, we're not sure what the average age is in today's webinar, but majority of our members, Roger, are just your mum and dads and retirees. A lot of the time, nearly every day, a lot of our members are asking me what stocks are fully franked, how they're going to fully benefit from an income stock. So the last column there is what Roger already said. It just gives our members an idea of what stocks are fully franked. And in fact, in our property stocks there, Roger, we're not showing them, but a couple of them are trading below their net asset value. So it goes back to what I was saying. We've got two good high yielders that actually are trading below their net asset value. So you're actually going to get a lot of capital growth along the way.
Yeah, very good point. And they're paying 7% plus in dividends. So you're virtually guaranteed that almost. I mean, there's no guarantees in dividends, but that's on track, and then plus the growth. So look, you can get that 17% per year if you maintain a reasonable portfolio. So we'll leave that with you to have something to think about. Chris, you've been with Fat Profits for how long? Tell us about that, and also if you can tell us more about who Fat Profits are.
Yeah, so I've been here for 11 years, so I've known Angus for quite a while, and we spoke about Angus. He wakes up at 5 a.m. He loves to just see what's happening globally in the markets. Again, a lot of you, even though you're not members, will know who Angus is. He's on television. We're going to go into a little bit later who our resource analyst is, but I kind of like this page, Roger. At 17, he turned $200 to $35,000, and he really hasn't looked back. He's always been in the financial markets. He's worked for different financial institutions. He's worked as a broker for some large corporations, and back in 2000, this is when he started Fat Profits. So we did launch in the Sydney office. As I mentioned, I've helped out in the London office for 5 years, and we've still got a presence over there. And then Angus introduced the wealth management division back in 2007, and we haven't looked back. Angus is a Kiwi. That's why we had to open up an office over there. But yeah, most of our analysts and the studio that we're in right now, Roger, we're in the Sydney studio. So we're really covering all markets. And as you can see, they're emerging markets as well. So we don't want to miss out on any opportunity. We're looking at what is going to give us growth for the next 12 months, 5 years, and 10 years.
Very good. Thanks, Chris. And just to be clear, we're not stockbrokers and we're not after managing your money. We are a stock market research firm. So we provide the research to self-managed investors, and you take that research on which stocks to buy, when to sell, and you manage your own money. You do your own trades through ComSec or whatever you're trading. We simply hold your hand and give you the advice on what to do in the markets, and you can take that advice or you can dump it. It's up to you. But Chris, you also work with David, who's also been with us for over 10 years. Tell us more about David.
Yeah, another face of Fat Profits. Again, you've probably seen him. He's on Bloomberg, AusBiz, CNBC quite often. And David has got a wealth of knowledge. He's got a team around him as well, but he looks after our resource report, which gives us the mining and all the different commodities. Heavily experienced, and he actually hosts along with you and Angus and other analysts our weekly member webinars. So it's good to just tap into experience like that, especially when they're writing the reports. Background as a geologist, he knows what he's talking about.
Yeah, absolutely. David's quite funny as well, if I might add. But yeah, look, he knows his stuff mining wise. And look, there's not many companies who have some excellent mining analysts, and David, we're very lucky to have him, and he is absolutely loved by members. So mining is an important component of everyone's portfolio, and he's been known to find some absolute gems that have made a lot of money for our members. Now, finally, just to tell members about wealth management, not that we're trying to sell this to you, but we also manage real money, and this is just to give you confidence. This is an example of our Australian portfolio, which we started in 2007. As you can see, the orange line represents our Australian portfolio with real money managed by Angus, and the black line is the ASX 200. So Angus and the team have confidently beaten the ASX 200 consistently, as you can see, over the last sort of 14 years, 15 years, and it's nearly tripled the ASX returns. And that's, again, we're very proud of that. People have invested real cold hard cash into these portfolios, which Angus manages for them, and it's been producing very good returns. So look, something we're proud of, we're happy with, our investors are happy with, and we want to maintain that as well. This is just to give you confidence that we got money where our mouth is, so to speak. Now let's talk about a few stocks now, Chris. Now that we've got that out of the way, let's look at a few stocks. As we know, Australia is now in the middle of a reporting season, and companies are reporting their last 12 months worth of earnings, forecast for the next 12 months, the dividend payouts, and it's going bananas. So one company, our flagship company, we can't go in a webinar without talking about Qantas, the flying kangaroo. Now, they've been under the pump since COVID really happened. It's been their absolute worst nightmare for a travel company. They're in debt, of course, and they've been struggling for some time. However, there is some hope, and we see some opportunity. So first thing first, we have a buy on Qantas, and if you look at the demand or the outlook as well, you can clearly see in April 2020 the demand for travel really dropped to absolute low, nearly zero actually. And then we've seen a little bit of rebound, then we saw lockdowns, and now we're seeing the easing of travel restrictions taking Qantas back up in the blue skies. Pardon the pun, but they are. And they're finally recouping some of the losses. Yes, they still have some work to do. Have they been perfect? No, they've admitted they've had challenges which they haven't been able to meet completely. But the financial position, they've recently announced their earnings. The cash balance as of last year was there, as you can see on the left, was $2.2 billion. But now the cash balance has improved. The forecast is looking quite good. All in all, we see some opportunity in this challenge. Yes, the stock was trading well over $7 before COVID. We have bought it a few times, especially around $3.79, in 2020 and a couple of other times. We think this stock has got every potential. If you can hold this for over 12 months, it can go past that $6 to $7 mark. and we see that as a growth stock. So that's the first buy recommendation from us to you today, is if you've got a bit of patience, that stock can provide you some growth. The next stock.
Can I just add, Roger?
Yes, sure.
Can we just go back quickly, just speaking with the analysts and preparing this webinar? A great example here, Roger, of dollar cost averaging and what we spoke about earlier. Now, the airline is actually going to remove, the analyst was saying, 15% of its capacity from July onwards, which is going to bring the capacity over 100% of pre-COVID levels in the first quarter of 2023. Here's an interesting point the analyst mentioned. The international travel, Rod, is likely to increase at 70%. And then 90% in the fourth quarter of 2023. They're bringing back the comfortable A380s, which many of us have flown on. So while the markets are still volatile, extremely tailwinds come in and a very strong forecast leading into 2023.
Yeah, very good points, Chris. Look, Mr. Joyce has got some work cut out. I think his neck is on the line. There are some people calling for his head at the moment. So he's got his work cut out. All right, let's look at the next stock as a buy recommendation today. Company that we know quite well, Nine Entertainment. And I think some people watching this webinar today probably using their products in some capacity, whether it's a Channel 9 or Stan, the streaming service, or domain.com.au for real estate searches, or something else. So Nine Entertainment is a buy from us. Why? Well, they recently announced their last 12 months worth of earnings, and was it a good result? Absolutely it was. So a few highlights here: strong cash flow, $570 million. Net debt was actually down. The dividends are pretty solid. They are fully franked, roughly around 6%, 7% dividends per year. They've also announced a 10% share buyback. All in all, the digital side of the business is also moving in the right direction. Chris, you know this company well because you've been talking to a lot of investors about this company. Can you add something here?
Stan, just as good as Netflix, I would say, Roger. So if anyone knows me, I'm an avid sports fan. So a lot of their, especially the Stan Sports, which is connected to Nine Entertainment, has done phenomenally well. As Roger mentioned, actually, there's three sectors of the company. The Stan Sports has actually surged revenue over 23% year on year, 23% year on year. What was very interesting, which a lot of people didn't know, is that digital growth actually increased dramatically. It was up over 15% year on year, which is just incredible to see. So we're not just focusing on one section of the company. We're looking at all different parts of the company, and also the domain business is what has actually been doing phenomenally well. Increased 28%. Now, a lot of people are saying, well, have we missed out? Well, at the end of the day, the company's actually forecast growth is continuing to grow organically as well, as you said, completely debt-free, and we've got them as a buy at the moment too.
Absolutely. And look, recession or no recession, but these sort of companies will remain pretty solid. And you can see here on the charts as well. I mean, it's a top 200 company, first thing first. Secondly, they pay 6 to 7% fully franked dividend. Thirdly, the digital side, as Chris mentioned earlier, is very strong. And the demand for the products will remain pretty solid for some time to come. So if you look at the charts, yes, we've had this stock for quite some time. This is initial buy was just over $1, but we have, as we talked about earlier, dollar cost averaging. We bought it multiple times at different levels, and then when it peaked around $3 and just a bit above, we took some profits. So not only we tell you when to buy, but the most important part of an investor is knowing when to sell. And this is a good case of locking in some profits, just half of them, when the stock went bananas over a period of time. Then we've gone back in as a buyer. So currently over $2, and it is a buy from us, and we see value both in terms of dividends and growth. Moving on to sell recommendations. Now, Chris, you know, investors need to know when to buy, but you know, as we just mentioned, selling is just as important as knowing when to buy. this list shows all our recent sell recommendations. We're happy to share them with them. What are your comments here?
Yeah, look, some people know when to buy, Roger, and sometimes they know which stocks to buy, which is great. We're proud of that they can do that. Knowing when to sell, though, or sell, we don't want to be selling premature, is another form of investing. So again, for the last 22 years, we're very proud about helping our members know when to sell or sell half. And listeners, you're probably seeing some of these stocks here. You're probably still holding them. You don't know what to do with them. So we're just sharing some of our recent sells or sell halves. I'll just focus on the one that we just spoke about recently. So we recommended Nine Entertainment at $1.08, only very recently. You would have saw on the last chart in the slide, we sold half. We don't have a problem with taking profits in a volatile market. You can see the percentage, nearly 177% return with an annualized return. If you were to hold them, you were making 44% each year return on Nine Entertainment if you just listen to us when we told you to buy, hold, and sell half. And the last column just gives our members a bit of an idea, Roger. If they put $10,000 into them when we recommended them at $1.08 and we told to sell half and just take some profits, well, that Nine Entertainment investment, is over 27,000. So just gives our members an idea. Some members use less. I know a lot of members put a lot more in. But just gives the members an idea of, or the listeners, of where we're taking profits as well.
Yeah, look, a lot of people probably invest more than 10,000 per stock, especially in a blue chip, but you're right. Look, we don't get all of them right. We are very open about it, and we're pretty honest. All our winners and losers are on our website. So yes, we don't get all of them right, and if you are expecting that, well, please don't. But we do get 7 out of 10 right. So this is an example. In fact, we've just got a question earlier coming from Karen. She said, firstly, she got some comments saying, we'll agree with your assessment on the recessionary risks with China in particular. However, I have a question on Whitehaven Coal because I'm holding it and I'm a bit worried about the recent growth that they've had. What's the panel's thoughts on Whitehaven Coal? Karen, if you can hold that question for a moment, we will talk about Whitehaven shortly and we'll give you our insights on it. But thank you for the comments. And we appreciate that. Let's move on to the next stock for now, and Hub24, which you saw in the previous slide as our recent sell recommendation, is a half sell as well. So another example of when we lock in some profit. So this is a financial technology platform firm. In fact, they're the fastest growing financial technology firm in Australia. They're currently, in terms of the best platform out there for financial advisors, they've been rated the best 6 years in a row. So you would have heard of them or seen them around if you're looking in that space. Now, in terms of their financial health, the funds under management certainly been growing and growing over the last 5-6 years, as you can see on the charts, pretty visible. What we've done is recently we've seen the sector come under a bit of pressure because of higher interest rates and higher inflation and a bit of tightening of the consumer spending as well. So all in all, that sector just come under a bit of pressure. And what we've done is, because we held this stock from early days, as you can see, $1.35. Now, keeping in mind, this is something we always encourage, and I know everybody wants the same, is buy low and sell high, buy low and sell high. But it's easier said than done. We do encourage our members to get in early when a company is young, fresh, and they've got potential for growth. But it requires patience. It requires dollar cost averaging. It requires researching and staying on top of it. And that's what we've done in many examples, but Hub is another example. So, Chris, we've recently sold half of this, and you've probably spoken to a lot of investors who've made a ton of money here.
Yeah, some have even doubled their portfolio, Roger. So don't get us wrong, listeners. We do still like the fintech sector. We've got quite a few stocks in the fintech sector. But again, going back to what we said earlier, there's no harm in taking profits, listeners, especially when the markets are volatile, especially when you're up 1,600%. So we're still happy with the company. In fact, the forecast and long term, there are going to be tailwinds on the horizon. They've got a lot of future growth through the organic of the business. But as we can see, we want to take a profit. We're still holding half, so if the stock goes up, which we do see it going up in the future, well, we're going to reap the reward. But if it did go the opposite way, no one's got a crystal ball, as Roger's saying. There's no harm in taking a profit. I'm sure our listeners don't mind.
Yeah, absolutely. In fact, I was speaking to a member last week, John, who's actually a long-term member of ours. He put in 20K in Hub24 many years ago, and his average was around $2. And he recently sold it to about 24. And yeah, he's made over $200,000. He's very happy. So look, one recommendation can do the trick for you. But yes, it requires patience. Yet it does require an open mind for you to take some action, and you need to pull the trigger. Let's move on to commodities now. And look, we talked about this earlier. The US dollar has been stronger and stronger over the last 12 months. As you can clearly see, it's in a bull run. It has been considered as a safe haven, which is not great for commodities. However, in spite of the US dollar running hot, one sector of the commodities, energy, has been very, very strong. As you can clearly see, oil, natural gas, coal, and other energy commodities have done exceptionally well. One of them we will talk about today is coal. And because coal in particular has been in demand, and you can see the 5-year chart here, it's gone from $50 in 2020 now to $412. Unbelievable. So what's that done? And how have you benefited from it? Because we've been flagging this to our members for some time. And Karen, here we go. We talk about Whitehaven now. One of the stocks that we've bought last year, because we were anticipating coal to run pretty hot over some time, is Whitehaven Coal. Now, this is a classic case of a company which was struggling. They were in debt and in a downtrend for many, many years. But as soon as the commodity prices started rising, we knew that this company has got the best chance to turn that around. And recently they announced their full year earnings. And wow, look at these figures. Financial year 18, 19, 20, 21, and look at 22. It is out of the park. And you can see everything else, you know, they've turned, and this is an important figure. The cash generated from operations is unbelievable. And they've turned from being in debt for the last 4 years in a row to now cash flow positive. So the return for shareholders has been phenomenal. And Karen, I'm sure you're sitting on some very good gains. They've been the best performer in the top 100 in the last 12 months. Their total shareholder returns, 154%, everything pointing in the right direction, more dividends, share buybacks, cash flow coming through in shareholders' back pockets, and look at the share price chart. So Karen, to answer your question, what we've done in our current recommendation is, you can see here, we bought it at $2, just over $2, bought it a few more times to dollar cost average, and we locked in some profits on the way. And this is something we tend to do, is when the stock has risen quite heavily, we don't mind taking some profit. So we've sold half. We are keeping the other half for now, but we're keeping a very close eye on this, the coal price. So short term, we are going to hold this for a little while longer. But if we start to see any signs of things changing with potential recession fears coming true or otherwise, then we will lock in the other half and just sell the whole lot. But if you want to be updated with this, we encourage, if you want to join us as a member, we can certainly help you with these buy, sell, and hold recommendations on a weekly basis. Okay.
Roger, can I just say something quickly?
Sorry.
Because I was in a meeting with David yesterday just about coal. Listeners, this is a great example of a rising commodity price and buying a good company at a low price. Coal back in 2021 was only about $140 a ton. And that's when we recommended it roughly at $2.08. Fast forward to now, you know, $7.80 is the stock. So speaking with David, he's very excited with other commodities. And as Roger said earlier, listeners, to get in early while the commodity is down. A great example of that is gold, very cheap at the moment. And we've got some recommendations as high conviction buys. And we're going to be just waiting patiently for a rise in commodity price, and then we'll reap the reward just like we are doing at the moment with Whitehaven Coal.
Great point, Chris. I appreciate that. Chris, while you're talking, you might as well tell us about our results,
Yeah.
because I think everyone listening today, they want to know, how we've been performing, because that's what it's about. It doesn't matter how good we are, it's all about the numbers. So can you share with us our numbers over the last 20 years?
So yeah, this kind of self-explanatory. The income portfolio that we showed was over 10 years for our income portfolio doing 17.1. But since inception, since we started the business, our Australasian equity report, if you were to follow it using monopoly money, that's what have been performing 17.8%. If you compare that with the All Ords, having a look at the ASX over that period of time, roughly it's been doing 8.5%. The difference, well, again, that's self-explanatory. This is why a lot of our members appreciate what we're saying, because we're actually doing, just giving the members a bit of a guidance as to what they should be doing. The bottom figures, we've basically brought it down to individually the years. So just to give you an example, 2020, a very interesting year for all of us, but the portfolio averaged at a 20.2% return, where the All Ords really struggled at 3.6. So the difference for that year was 15.5. So overall, for listeners, this is the performance that we're doing at the moment. And again, we can help you with your own portfolios.
Thank you, Chris. So look, more often than not, we get it right, but we're not perfect. So we don't get it right all the time. We just want to be very honest about it. We can have some bad years, and we've had over 22 years. You're bound to have a couple of years where you get it wrong. But look, this is, as Chris said earlier, monopoly money or real money. This is just a quick example of if you were to hold positions in good quality companies, and if you could maintain that return of 17 to 18% annually, what would that do to your investing? So if you'd invested $10,000 20 years ago, and you keep investing $5,000 a year onto the same portfolio, and you just hold this over a long period of time, today that portfolio would look like $1.6 million. Just a small $10,000 20 years ago. This is just the power of compounding interest. So we're just demonstrating that buying and holding is the way to increase your wealth. Not trading, because trading is very tough. Now, Chris, we have independent reviews posted on productreview.com.au by our members who are sharing their own experiences, some quirky ones, some serious ones, but some interesting reviews. So can you shed some light on some of these?
Yeah, and that's open to the public. As you can see there, 4.1 over nearly 300 reviews. Again, a lot of our members, these are all of our members, they're telling the general public how they feel about the service. I like the point Nick makes. Simply love the mining analysts, and we've already spoken about David and his resource team. But Nick actually has done very well with lithium, copper, and gold, and that's what that report does. So you can go and have a look at these, the feedback from members. I think one of them in an additional slide is one of your members, Roger. I think he said the best thing since sliced bread. So yeah, it's nice to hear what our members are doing in regards to using the service and taking advantage of the research.
Yeah, thanks, Chris. Yeah, this review here is actually I spoke to Dave recently, and yeah, he posted quite an interesting review. He's been with us since 2009, and he's extended for another 5 years. He's a sophisticated investor, has an MBA qualification. He finds Angus as a financial and economics guru, and find David Lennox a resources guru. But he's had pleasant dealings with all our other staff. But I think two things would stand out here at the bottom. It says, first, two reasons he continues to subscribe. First is since 2009, his records indicate that we are more correct far more regularly than we're wrong, and B, they come across so friendly and courteous that it feels like they genuinely want me to make money. It was really warm, and we felt really good about that, so that was great. But yeah, on a funny note, Chris, you're right. Doug actually had a note there saying the best thing since sliced bread. I mean, that made us all crack up in the office, but interesting there. So look, lots of reviews. More often than not, positive reviews. Most people have had some good experiences. Here's another David. He's a retired fund manager and stockbroker, and posted a pretty long 5-star review for us. So something for you to consider. But look, there's multiple reasons for you to join our service. Chris, over to you.
Yeah, listeners, if you've just come across Fat Profits, if you've known us for a while, this page, we'll get to the packages, but this page should really, I guess, incentivize you to come on board. We've got 6 points here. So as we see, the performance since inception, we've been averaging 18% each year. And we save time on research. A lot of our members, as I said, are retirees, mum and dads. They don't know what to do. They don't have the time or inclination, and they know they can follow our research independently. And as we saw, Angus, David, the other analysts were on television. We know what we're talking about, especially with their experience. And as I think Roger said a little bit earlier in the presentation, we're getting 7 out of 10 right. So more often than not, we're helping our members know when to buy, when to hold, when to sell half, and when to sell. And what we actually haven't mentioned is what to avoid, what to watch, which we actually tell our members what we're looking at before we're going to buy the stock. And to make this point very clear, listeners, we are not a marketing company. You're not going to subscribe to us and need to spend more in order to get more information from us. So once you've paid for the research, you get everything, and we're happy to answer any questions that you have. And as we've shown with Angus and the wealth management team, we actually are managing money here. So these just gives you, even take a screenshot of this. This is why people are subscribing to us and actually reaping the reward with Fat Profits.
Thank you, Chris. And look, for those of you interested in joining our service today, we will explain the 3 products we have. This is all we have. These are the 3 products. So you choose one or the other. So we have a standard membership, a premium membership, and a platinum membership. And how it works is, and I'll explain to you this. So we have a daily Fat Chat market commentary. So that's the email you get every morning into your inbox from Angus. So as the fund manager, he tells you what's going on. He provides charts, indicators, and where he sees the market. Really informative, puts you in the picture. You don't need to do anything else for that day about markets. You're well informed. Secondly, you get a weekly members only webinar, which is every Thursday at 12 p.m. for 1 hour. That webinar is hosted by David, Angus, myself, and a couple of other analysts. We all talk about 15 to 20 stocks in the webinar. We talk about the macro, what's going on in the global markets in Australia, and we take your questions. It's interactive, so you can ask questions live in the panel. So that's available. Plus, if you miss it live, not a problem. You will be able to replay the recording at your own convenience. We email it to all our members. Third, you get a Friday Fat Wrap. What that means is a wrap up of the weekly highlights in the market. So if you missed out on something, on Friday evening, we'll email you all the highlights of the week, which will be well informed again. Now, the juicy part of our service is our weekly stock reports. So we publish 4 reports each week. First one is Australasian Equities Report. That covers Australia, a little bit of New Zealand, and a little bit of Asia. So if you're interested in these markets, especially Australia, then that report is an absolute must. It covers all the major sectors of Australia. So that's the first. Comes every week with 4 to 6 recommendations, and each recommendation is either buy, sell, or hold. So that's first. Second report is global mining. Now, although the name says global, but don't be afraid, most of the mining companies here are Australian miners, about 80%, and 20% of the other mining companies are international mining companies. So this is important for growth, because if you want the mining in your portfolio, then this will help you get a couple of good lithium, nickel, gold, as Chris said earlier, or maybe even coal and energy companies. Third is global equities, and that covers international markets like US, Europe, and Asia. And finally, the UK equities. So Chris, could you explain a little bit about the account manager side of things?
Yeah, so the standard package basically is a DIY, but yeah, the premium and the platinum, basically, I think Karen, was it earlier talking about WHC, Whitehaven Coal. So yeah, anytime a member has a question, Roger, or just telling you listeners, if you ever have a question, you don't know what to do, you want some reassurance, you want to be updated on what Fat Profits are doing, The beauty about these services, and again, we pride ourselves on these listeners, you can call up, you'll have an account. We've got a whole customer service department, but you get an account manager. You've got someone you can build a relationship with. There's no such thing as a dumb question, Roger. So our listeners can call up, even if it's a minute question, we can get the answer for you. And hopefully that just helps our members make a better informed decision, a bit like asking a big brother for advice, and they hopefully can go away and make the decision.
Yep, very good. So with the premium and the platinum, you will have an account manager associated. And the difference is with standard, you can pick one of the 4 reports. With premium, you can choose 2 out of the reports, and platinum, you get all 4 reports. So most of our members who are Australian investors, they would go with premium because they can choose Australian equities and mining. If you're an international investor, then you will go with the platinum because you can have all 4 reports, including overseas, and that gives you better coverage. So just to show you, I mean, this is an example of how the Friday Fat Wrap looks like, some quirky pictures, and the webinar each Thursday, we email you the recording and you just hit the play button and you can fast forward as well. So that's all available to you. Now, before we show you some discounted offers today, I'll take you into the website and quickly show you how our website looks like. So when you log on to the website, you go to the members homepage and you scroll down. There is a short video, which is introduction video, which will help you get familiar with all the buttons and where things are. But you can see here, you got the daily fat chat, which is the daily email. You can click that here and read it. There is the Friday Fat Wrap, any highlights of last week. There is a weekly podcast. You can just click it here. Angus talks about every Friday about the markets. And then you've got the 4 products. So we've got Australian equities, UK, global, and mining. So depending on your subscription level, you will have access to all these tools. As an example, Australian equities, it gives you the latest report. You can read all the new recommendations here, the buy, sell, and hold. You can look at our Fat Profits portfolio, our preferred stocks, all our past recommendations, every winner and loser, 7 out of 10 right. That's all here. Alerts, we will also alert you if there's a stock which moves up or down dramatically because of an announcement. Our income portfolio, which we showed you earlier, that's all available here. And all our webinar recordings, you can just simply click that and scroll down. You will see all the recent recordings here, and you can just hit the play button and you can play them back. So that's all available for you. Now, in terms of pricing, look, it's probably the burning question in your mind as to what's the price. Look, it's pretty simple. We're not the most expensive out there. We're not the cheapest. We're somewhere in the middle. So between standard, you can join that for simply 1095 for a year, or 2 years a little bit cheaper. Premium is only 1545 for a year, and 2 years a bit cheaper. Platinum is 2590. That's certainly got all the bells and whistles, and 2 years is certainly cheaper. Now, regardless of which one you go with, look, keep in mind, all you need is 1 Whitehaven Coal from us, or 1 Nine Entertainment, or 1 Hub 24. And if you put in $10,000 in one of those stocks, as an example, and you hold it for a period of time, it can pay you back many times over. Just one good recommendation can easily cover this. So it's not a problem for most people. However, we do have an option today where we've got some really good prices available for you to take advantage of. So Chris, could you do us the honors and tell us these special offers that we've got approved today?
Yeah, and if you listeners want to take a quick screenshot here, just gives you a bit of an idea of what we're offering, a heavy discount. So if you're looking at the standard, the best options are obviously the 2 and 3 years and follow that. Yeah, but the bread and butter is the premium and platinum. So we've got 2 years, as you saw there, it was $27.95. We've got it down to only $8.99 per year. We do have a 3-year option as well. 3 is even better value for money. So we work on annual rates here. So you're only going to be paying $765 per year to get all of our recommendations in the Southern Hemisphere and the account manager. But again, as Roger, as Roger mentioned earlier, some of our members do look at global. There is a lot of opportunities. We even spoke about emerging markets, and the platinum is heavily discounted. So as you can see there, you could pay $1,295 a year per year to get our platinum service. And Roger's going to go into it a little bit later, but the best value one there for only $999 a year for 3 years, you're going to get global research from us, and includes a very interesting point there, Roger.
Oh yes, thank you, Chris. Look, I agree. Look, the platinum is very popular at the moment because what we've done is if you take the 3-year option, we not only we reduce the price down to $999 per year, so all up you're paying just under $3,000. But wait, there's more. With the 3 years, we're not throwing the steak knives, so don't worry about that. We'll keep them to ourselves. But we are offering annual portfolio reviews for this 3-year membership. How this works is very simple. You email us your portfolio, we'll give it to our analysts. They'll spend a couple of days dissecting it and make sure we come back to you with the recommendations. And then we'll schedule a half-an-hour appointment over the phone where we discuss your portfolio in detail. Now, one of the things we look at is your overall weighting, the number of stocks you're holding. Is it too less or too many? Are you holding some quality companies? If yes, they'll get the tick of approval that yes, no changes. The other ones where there might be some concerns, we will recommend either a half sell or a full sell. As long as you're open-minded, you want to get a bit of a health check. And if you haven't had anyone look at your portfolio, well, it's a bit like going to the doctor. You know, you don't want to go there when all things are going down south. You want to go even when you're healthy, just to make sure you trim down any fat and look at any concerns. And there are concerns in the markets right now. So that will really help you out. And we're doing a lot of them every day at the moment because we have thousands of members and they are sending the portfolios daily to our analyst. So look, if that's of interest to you and you haven't done it before, look, absolutely a bit of a no-brainer at $999 per year. Now, keeping in mind, regardless of which one you go with, we are, you know, it is most likely tax deductible for you, and we will give you a tax invoice either under your personal name or your super fund, whatever you prefer. And for most people, generally, it is a tax deduction. So what I'm going to do now is I'm going to pop up a question here where you can register your interest, and it shows you which membership would you like to join, standard, premium, platinum. Or if you want to discuss it a bit further, if you still have some questions, not a problem. You can choose the last option and we can get back in touch with you and clarify things before we sign you up. So on that note, we've got a number of questions popped up now, Chris. So I'll go with the first one. This is from John. He says, guys, great presentation so far. Love the analysis and especially like the annualized returns over such a long period. I am particularly interested in the income portfolio because I've recently retired and I'm leaning more towards blue chip dividend paying stocks. His question is, if he joins on the platinum service today, on the 3 years, will he be able to get his annual portfolio done this week? Because he's concerned about the market drop in September, October, and he wants to trim the fat a bit down. So Chris, how quickly can we do the first portfolio review?
Yeah, you're very enthusiastic there. I like that, John. Absolutely. So after the presentation, John, you can do one or two things. Just click the platinum, or if you have a question, Roger and I will probably have a chat with you and just see if we can get the portfolio sent to one of us this afternoon, and then we can get it certainly done maybe midweek, I'd say, Roger, looking at the schedules and the calendars. But we want to make sure that we look at the portfolio thoroughly before we come back with feedback. But yeah, we probably need to organize that sometime this afternoon so we can have it in our hands before the weekend. But good question, John.
Excellent, thank you. Next question is from Margaret. She's saying, I'm an ex-member of yours, actually dropped out about a couple of years ago, went into property, done quite well, liked the presentation. I'm actually sold the property recently. Well done, Margaret. You've probably done quite well.
Good timing.
Good timing, yes. And I'm looking to get back in the stock market and leaning towards the premium package because that's the one I had previously. However, the question Margaret has is the premium Australian equities and mining is what I'm leaning towards. However, if I want to change one of the reports from mining to global equities, let's say a few months down the road, can I swap one of the reports down the road?
Yeah, good question. Yeah, we're very flexible here, Margaret, so that's not a problem. We can even show you what the global mining report looks like, and you can have a taste of it. But yeah, a great time to be in cash, as Roger said earlier. The markets will be quite volatile over the next few months, so you don't have to put all of that money into the markets next week, but certainly we can tell you what stocks to be watching. And also, have a look at some of the other reports as well. So to answer your question, Margaret, yeah, we're very flexible here. The main reports in the premium are the Australasian equities and the mining, but we can also show you some of the other reports as well.
Excellent. Thank you, Chris. All right, well, I'm just going to close this question now. Looks like we've got quite a few, about 22% have chosen platinum, and we've got about 16% on premium. There's a couple on standard as well, but not many. But look, thank you for those who have shown interest in joining at such a discounted rate. We appreciate that. For the others, if you're not convinced and you think your current system of research is working well for you, getting you more than 17 to 20% returns per year, then we wish you well. And thank you for joining us today. Finally, look, for those of you joining our service today, we do have a hidden gem. And this is a stock we believe we're going to give you straight away as soon as you join our service. And this stock is a gold miner, recently become a producer, and they're based out of Western Australia. You can see the new mine that they've got, and they've installed all the components. They've actually started producing in June, and they're now ramping up the production in this huge mine that they have. This mine will be lasting 16 years, and they'll be forecasted to produce 2.5 million ounces of gold. And this is a picture of the recent gold that they've started producing, and they're now ramping that up. And as you can clearly see here, right at the bottom, full production is forecasted to finish by December quarter this year. So they've still got some time before they ramp that up. This mine, if you look at the chart, has gone up, well, from 16 cents about a year ago to a high of 47 cents. Which has made some good money, but also recently retraced with the gold price coming down and now trading around from bounce off 22 cents back to 27. Chris, this stock looks pretty promising. If people can have 2 or 3 years time frame in mind, this is a potential game changer.
Yeah, even less, Roger. It's actually one of our highest conviction buys, and I can nearly guarantee if you come on board with one of these memberships, you'll definitely put this at least in your watch list over the next few weeks. A great example there. Look, we're so confident in this stock, nearly $1 billion mine in WA, so they're not tiny, completely debt-free, Roger. Actually, they got $50 million in cash. So even if they did have a hiccup, they can certainly look after themselves. And one thing we like about them, a bit like Evolution Mining, they're a very cheap gold excavator. And that's what we like. And going back to what we spoke about, coal and Whitehaven coal, a rise in commodity price and gold at some point is going to rally. So their profit margins as a company, Roger, just going to continue to increase. Now that they've started producing, they've done all the hard work, doing all the excavation. Now they're going to start producing, which they have in June. And again, you don't have to throw your firstborn in it, but you got to be in it to win it. And we're very confident with this stock and this sector. So if you call in or you've tick the box and we forget, just ask us who the hidden gem was. We'll be happy to help you.
Absolutely. Even if you put in 5,000 or 10,000 into this company and you've got a couple of years in mind, look at 27 cents. If it does what we're expecting it to do, you'll do very well out of this and most likely pay your subscription over many times over. So please don't forget to ask us about this stock and we'll be happy to help. So look, that brings us to the end of today's webinar. If you still have any questions which were not answered, please email info@fatprofits.com.au and we will get back to you with the response. But apart from that, look, thank you once again for your participation. We appreciate you taking some time out to understand how Fat Profits sees the markets. And hopefully if you join our service, we can help you navigate through these tricky markets right now. My name is Roger. It was a pleasure hosting you today, and I'll pass it on to Chris for his final words.
Thanks, Roger, and thanks to all the listeners today. We did hope that you found that interactive and beneficial. And as we said, any questions, email us in or just call in. We're happy to help. But have a lovely day.
Okay, bye-bye.